everybody is doing well. It's another beautiful day. As we all know, Transformation Start is a platform where we all come together, learn more about life, educate each other, inspire, motivate, and I hold not yet. So we're glad to be here. And I know more people are yet to join, and others are also joining on YouTube. So just feel free, enjoy what we all have to share today. Yes, today we have a wonderful topic to discuss, and it's a topic that everybody want to hear about because we've talked about investment, we talk about how to make more money, how to open more businesses. And 2 weeks ago, we had a wonderful person, Miss Priscilla, talk about real estate. And today we have a wonderful guest speaker who's going to talk about loan and how we can tap into some of the available loans on the market if you want to go into an investment or if you want to go into some type of even your own residential property. So, with not much ado, I'm gonna introduce you to our guest speaker, Miss Baker. Miss Baker, you are so welcome to our Transformation Talk. I'm Dr. Eugenia Caternor. I'm the host, and I'm gonna let you introduce yourself and tell us a little bit about what you do and why you're in this profession.
Sure. Yes. Thank you for having me. My name is Myeshia Baker. Excuse the name on the screen. I couldn't change it. That's my daughter. um, but thanks for having me. I wanted to talk about lending today and the different type of loans that is available for real estate. Um, so give me 1 second and then I'll start with my background. So the name of my company is Gorilla Consultant, and we do loans for real estate investors and also for businesses. I have many years of experience in the real estate industry. I would say over 10 years. And I always talk about the multiple streams of income that you can generate within real estate. So over these 10 years, I've done, well, our businesses consist of property preservation, real estate investing, of course, acquiring government contracts through for residential properties, also doing inspections. And then, of course, what I am here for today is the lending aspect. So, people, social media, I would say, make real estate investing like the primary thing that everyone should get into. And yes, that will always be something that I hold in my portfolio. However, there are so many different ways that you can create streams of income within real estate. So I'm glad to see that Dr. Eugenia has created this platform that teaches you those different things in real estate. So I wanted to start by telling you the type of loans that we do for investment loans. So give me 1 second, I'm sorry. Okay, so there are different type of loans that you can acquire for investment loans. The first thing I want to say is the type of loans that we do in our company is for investment loans only. These loans cannot be used for your residential, for your primary residence. They must be an investment loan. Okay, so we do fix and flip loans, which I'll go into detail about what each of these are. Is fix and flip. We also do long-term loans up to 30 years. We refinance residential properties. We do long-term loans for multifamily property, sorry. And then we also do ground-up construction loans. So I'll explain a little bit about each of these next. The primary one I think that a lot of people get into first is for fix and flip loans. Now, these loans are for properties that require rehab. So if you're looking for your first investment property or an investment property, period, The property type is for 1 to 4 unit or single family homes, and then townhomes. And just say you find a property below market price, and it's because they're selling the house as is, and you have to put some money into the property in order to improve the condition of it. So these are the type of loans that you would use for that property. And the reason is because the bank will give you 100% of the money to rehab the property. So they give you up to, depending on your credit score and experience, it can be up to 95% of the purchase price, and then 100% of the rehab. The minimum credit score for these loans is 660. Um, Although that is the minimum, if you have less than a 680, it's more approvals that's required. And then there's more money that they require down at the table. So I like to work with my clients and look at their credit to see what improvements need to be made to increase their credit score some before I get them an approval at 660. You know, if it's a loan or a property that you're trying to acquire and you really want it and you have the cash, then great. But if you can save some money at the closing table and do a few things to increase your credit score, I always recommend that you try to at least get a 680, but it's best, of course, to have a 700 credit score. And we do work with our clients to see what needs to be done in order to get there. You do not have to have any real estate experience. The more experience you have, though, there are extra benefits where you can pay less cash at the table. But of course, you can start with no real estate experience at all. We don't need to see income verification. We just need to see proof of funds. So I'll show you towards the end of the presentation a few term sheets to show you what I'll send to you if you call and say, I have a property that I'm interested in. This is what the numbers are. And I can send you back a sheet to show you what your interest rate would be, what the monthly payment would be, what your down payment would be, etc. So on that sheet, it shows how much cash the lender wants to see in the bank in order to approve you. They do, if there's like a large deposit made into an account within the last 30 days, they will ask for an explanation of where that money came from. And they just really just want to make sure that you're not taking money from a credit card and then putting it into your account. That option is available. I even use that method, but there's ways to do it. And I help guide my clients through that process to make sure that you're doing it the right way so that you can get approved for, you know, the loan that you're looking for. The minimum loan amount for these loans are about $50,000. I would say on average is 75,000, but there are a few lenders that's still doing it for $50,000. This loan amount does include the purchase price of the property and the amount of money that you want to request to rehab the property. Interest rates for these loans is 8 to 9%. And you have to keep in mind too that these are short-term loans. The average time that you have a fix and flip loan is for 12 months. However, they can be extended up to 24 months. It's best with these loans that you get in and out. In the beginning, when you're preparing to purchase the property, you need to have in mind how much work has to be done to the property, how long will will the rehab take, and then what is your estimated completion date to either sell this property or refinance it if you're going to keep it as a rental. So you have to keep that in mind because these are interest-only loans and it's at 8 to 9%, which is a high interest rate for mortgages. However, these mortgages are short-term and they give you the money to rehab the property. So that's why it's at a higher price. So what I'm doing, my fix and flips, I already include in the total loan amount the cost that it will take for me to hold this loan. So let's just say I'm doing a big rehab. I know that it's going to take me 12 months. I need to include that cost on the front end in the rehab budget so that when I pull the money out of the draws, that the draw itself pays for those monthly payments. Especially if I know that it's going to be a while before I'm able to refinance. On average, most of my clients refinance out of this loan in about 3 to 6 months. Okay, and I guess I'll do questions at the end. So this is fix and flip properties, or fix and flip loans. If you have any questions about that, just make sure you take note of it, and then I'll answer them at the end. The next type of loan is a DSCR or a rental loan. So this is a property that you find online or off market, and it needs little to no rehab. These are turnkey properties where you can put a tenant in there within immediately or within 30 days because there's not much money you have to put into the house. With these loans, you can purchase the property and go straight into a 30-year mortgage. Um, you're able to finance up to 80% of the loan value. I'm sorry, of the property value. The minimum credit score is a 660. There is no income verification, and interest rates for this loan is as little as 6%. So for long-term loans, the interest rates are much lower than the fix and flip, which is a short-term loan. So next we have refinance. So these are for loans for properties that you did a fix and flip on, and you decided to keep it as a rental instead of selling it. Once that loan has expired or you have completed the work, you can go into a 30-year loan program. And when you do that, you have the option to pull out some cash from the property if you have enough equity in there. So you do a cash out refinance. Or if you say, no, I don't want to pull any cash out, I just want to go into a 30-year mortgage and get a lower interest rate. So those are the two options you have for a refinance. You can, for cash out refinances, you can take out up to 75% of the appraised value. So if the house appraises for 100,000, you can take out up to $75,000. That other 25,000 does have to stay in the property just as equity and cushion, a reserve that the lender likes to keep on the property. The minimum credit score for a cash out refinance is a 680. Interest rates are as low as 6%. And they do offer a buy down system, which I have an image to show you, to explain that to you. So basically a buy down system is you pay more points at the closing table to get a lower interest rate and a lower monthly payment. So I'll show you that in a second. The other option is a rate and term. So a rate and term, this is just, you want to just get a lower interest rate and you want to go into a 30-year mortgage. You don't pull any cash out. So you can get up to 80% of the appraised value for these loans. You can wrap your closing costs in the loan if there's enough equity. So you don't have to bring any cash to the table as long as it was a good deal and there's enough money in there to include your closing costs. The minimum credit score for this is a 680. The interest rates also is as low as 6%, and this also has a buy down system. So this is an image here, and I hope you can see it to explain to you what I mean by a buy down system. So here in the center, it shows that I am pricing this loan for a loan amount of $280,000. And then it shows the next row here is the rate. So the interest rate can go anywhere from 7.475% for this loan, and then as low as 6.54%. Now this client did have a 682 credit score, so they're only able to get up to 70%. You do have to have a 700 credit score to get the full 75%. So they're able to take out 70% of the loan amount, which will give them the $280,000. The monthly payment goes anywhere from $2,286 down to the lowest would be $2,110. So when I say buy down, if you see here on this, the first column, the left side, it shows lender buy down. So this first one says 0 points. So this is basically saying you don't want to pay any cash at the closing table. You want to get the most cash out of the loan as possible. You're okay with doing a 7.75% interest rate, and the monthly payment of $2,286 covers what you'll be getting from the rent, from the rent from your tenant. So 0 points, you're saying you don't want to pay any extra money. You want to cash out as much as possible. But if you're more concerned with interest rates and monthly payments, then you'll say, Myeshia, I would like to do a 3.5% at the table. So this is saying that you'll pay an additional 3.5% on the total loan amount of $280,000. You will get a 6.5% interest rate, and your monthly payments will be $2,110. So a lot of my clients, they do go in the middle, in between both, and they might do a 2%. So they'll pay an extra 2% on top of the 280,000, and then they'll get a 6.9% interest rate. And then the monthly payment is $2,185. So once we have your loan terms, we're able to determine or go through this for you to determine which option you would like to go with. But I like the flexibility that our lenders offer because it gives you the option to decide where you want your interest rate and monthly payments to fall at. All right, so that's the buy down system. The next loan type is a ground up construction. I'm not going to stay on this one too long because we don't do as many ground ups. All of our lenders do offer this as an option. We do have the property type can be anywhere from 1 to 4 unit building, and you can even do an entire subdivision. They do want to see some experience with this. There are lenders who will accept clients with no experience, but you just have to have more cash in the bank, and you just have to show proof that you're able to see this project through. So it's good to have a good team behind you that has a resume that you can show to prove that you would be able to see this project through. These loans are 12 to 24 months. The interest rates for these start at 9%, and you can actually finance up to 90% of a ground up construction loan. Um, Give me 1 second. All right, so the next thing I wanted to show you was the actual term sheet so that you can get a better idea of what I mean with the terms that I send over whenever we pre-qualify you or you call in to say that you have a property. So when you call in and or you send me a message and say, hey, I'm interested in this property, I'll ask for a few things. It'll be the property address. If I don't already have it for your pre-approval, we'll need your credit score. Um, and then I'll need what the purchase price of the property is. And then if this is a loan that you are going to rehab, we'll need the after repair value. So with that information, I am able to generate a term sheet that will show you everything the loan will have and how much money you have to bring to the table in order to close out on this loan. So give me 1 second. I'm transitioning to another screen, and then I'll show you that. Okay, so this option here is for a long-term refinance cash out. So this is a term sheet that you'll receive. It includes the loan type, the type of property that you provide to me, the interest rate. So this one is at a 750 credit score, the as is value of the property, and then this has an estimated payoff because again, it's a refinance. Um, the insurance premium and taxes, if you don't have that, it's okay. That is something that I can look up or we just estimate. And then whatever you think the monthly rent will be on the property, we'll need that estimate. So here, the loan amount for a property that's valued at $240,000 is $180,000. This loan did have a 5-year prepayment penalty, but that is another option that's available too. If it's a loan that maybe you don't think you're going to keep the property that long, you can get a 1-year, 2-year, 3-year, or even no prepayment penalty. But the least that you go, the interest rate does go higher. This was just as of last week when I did this. So the interest rate for this one was a 6.4%, and the origination points was 4%. So the total monthly payments for this loan would be $1,369. This section here where it says estimated lender loan fees, this shows you how much you have to bring to the table. So the total estimated lender fees is $11,185. So that's usually the cash that you have to have at the table. However, because this is a refinance, that cash will just come from the loan amount. And then the bank wants to see the total liquidity requirements. This is what they want to see in your account. So this is for standard for a cash out refinance, a fix and flip, whatever the loan type is, the bank wants to see a certain amount of money in your account. And when I send this over, this is the number you're looking for to confirm that you'll have that money in an account. The accounts that it can come from can be a business checking account, a personal checking account. It can even be a retirement account. For retirement accounts, we can only accept 50% of the total balance that's in your retirement account. Now, if you have a partner and they are on the loan at more than 20%, we can include their income. I'm sorry, not their income. We can include their checking accounts for proof of income. And we can also include their experience. If you're working with a partner who has done some real estate experience and you don't have it yourself, we can include your partner's experience, and that does help you get a lower interest rate as well. All right, so so this is for a long term. The term sheet for a fix and flip is basically the same. So I don't want to bore you with showing you this anymore. But what I do want to do is I can open the floor for questions, but I also want to let you know that you can how to contact me. You can reach out to me on our website at gorillaconsulting.com. I'm going to share that with you again, the slide. And then when you reach out to us on the website, we can get you pre-approval ready. So we can take a look at your credit report, see where it is, see what needs to be done to get you to the credit score that's needed to get you approved for or finance for a good rate and less money down at the table. You can go on the website to schedule a consultation with us. And again, the website is at the bottom of the screen. It's www.gorillaconsulting.com. And I will open up the floor for questions.
Wow, Miss Myeshia, that's a lot of information. Thank you so much for sharing. And I know a lot of people have questions. If you want to put it in the chat, or if you want to just unmute yourself, you can ask your questions. No question, it's a silly question. We are all here to learn. I'm learning as much as um, everybody else. So if you have a question, please go ahead and ask the expert right now.
Good evening. How are you?
Hello, good, and you?
I'm doing well, thank you. So my
Good.
question is, can you talk about a little bit about bank statement loans?
Yeah, so bank statement loans with the lenders that we use, actually one of them in particular, if you do a bank statement loan, you have to show, usually they want to see about 12 months
Hmm.
of bank statements.
Okay.
And with that, they will determine the amount of your approval based on your deposits in your account.
Okay.
So it's basically the same process. But with this, they're actually looking at your income and your deposits to see what you're bringing into the account. The other loan that I explained, they don't really care about your income or
Mm,
your deposits. They just want to see that the ending statement balance equals or is greater than the total cash that you need to have at the table.
okay. Got it.
Yes, but bank statements, they want to see that you consistently deposit or bring in a certain amount of money
Okay.
and that you will be able to afford and carry out the loan.
Got it. And my second question is, say if you are approved for a loan, which one is better to pay, interest only or interest and principal?
So, okay, it depends on what type of loan. Fix and flip, the only option is
Yes, for
interest
fix and
only.
flip, like so for fix and flip or like a HELOC.
So, okay, fix and flip, the only option for most of my lenders is interest only. They don't even allow you to pay towards the
Oh, okay.
principal. And that's because those are short-term
Time for
12-month
30
loans.
minutes.
I'm sorry.
That was my Alexa. Sorry.
Okay, no problem. And then for HELOC, so we do not offer HELOC.
Oh,
We only do, which were relate, I guess, closer related to a HELOC would be a cash out refinance.
oh,
And for those, you pay interest and principal.
okay. So
Okay.
cash out, refinance, and HELOC. What's the difference? May I ask?
So a cash out refinance, it means that you are getting one loan
Hmm.
to pull the equity out of the property. And that's all tied into one loan.
Mm-hmm.
A HELOC or a home equity line of credit
Mm-hmm.
means you have a mortgage, but you got approved for a line of credit based on the equity that's in your home. So
Mm-hmm.
it's a completely separate account
Okay.
that you pay towards. And with those, to my knowledge, you don't do interest only. You pay principal and the interest, and whatever you pay down, you can reuse again. So it's a line of credit that's reusable. And when you're approved for it, you use whatever you want.
Want to. Okay. Perfect.
Yes,
Thank you so much.
you're welcome. Any other questions?
So I have a question. With a HELOC, I know it's based on your income, even though it's your own money that you're
Mm-hmm.
taking out of. It's also have the income verification. But a lot of the other loans that you're talking about, you're saying it doesn't matter how much money you make.
Correct, yes. On the application, the lender does ask for the name of your employer, but that's as far as it goes. Um, Honestly, you don't even have to be approved for these loans. So we don't check your tax statements. The only thing we check on bank statements is the ending statement balance, and of course, to make sure that there's no like NSF fees and everything. Other than that, we don't care what your income is to approve you. Now, saying all of that, there is a lender that we work with who will review um, your taxes and bank statements and everything. And the benefit of working with them is that if the numbers are right and if it's a great deal, you don't have to bring any cash to the table. So these are loans that you can get for fix and flip properties where you can buy with zero money down and they will finance 100% of your loans. So if I have a client who's employed full time, they have great income and a good credit score, I will always try to get them a loan through this one lender before going to the other ones that don't require any income.
Well, so that being said, every one of us here can actually get a loan for some type of property.
Oh, absolutely. Yes. Absolutely.
All right.
And depending on the deal, you can go anywhere from zero money down to up to about 20% down. That's the range. And again, we include 100% of the rehab.
Wow. I mean, that's really good to know. And for the income, I mean, we can use, let's say, 401k statements, correct?
Correct. Mm-hmm. Yes. And if you're at retirement age, they'll include 100% of
Mhm.
whatever is on your retirement statement, 401k, IRA, whatever type of account it is. If you're not at retirement age, they will only include 50% of that.
Okay. And do you know the amounts they're looking for? Let's say their property is $200,000, and let's say you have 80,000 in your 401k. Would that be sufficient? So half of that would be 40,000.
Yes, so the loan that we just looked at with the term sheet, that loan amount was $280,000, and they only wanted to see $25,000 in the bank account.
Hmm.
And that proof of funds is based on the cash that's needed at the closing table for the lender and then the closing costs on the title side. So transfer taxes, your insurance, anything that's due on title for the property.
Okay.
The other thing I want to add too is that you have the option to include reserves for the property. So if you don't want to make monthly payments and you just want to include the monthly payment into the cash down that you pay at the closing table. So that's an option as well.
Okay. All right. So I guess my next question is, does it have to be in the states that you reside in, or you can get this property in other states?
Yes, you can get the property anywhere. We lend in all 50 states in the country.
Okay.
Yep, so it can be anywhere.
Okay. Very good. Any more questions? Let's see. Okay, everybody's just listening, and
I have a question.
Yes.
Hi, Myeshia. This is Priscilla.
Oh, hi,
Uh,
Priscilla.
hi. So, what did you say was the um? I think I have two questions. So, did you say if you have to do a fix and flip, you need to have some kind of experience to be able to do it? And if you need to have the experience, how much do you need to show in your bank account to be able to do the fix and flip? I'm sorry I was late, so I didn't hear if you've already
No,
answered.
it's okay. Nope. So for fix and flip, you do not have to have any experience whatsoever. This can be your first investment property that you've ever done.
Okay.
You don't have to have experience. Now, I did say it's always great if you do have some experience because the more experience you have, the lower your down payment will be and also the lower your interest rate. But because of the higher risk of financing someone who has never done a fix and flip, the interest rates are a little higher, and then you do have to bring more money to the table. But as I always tell my clients, you have to start somewhere. So that's the starting point to you getting into this business. So with the first one, you are going to pay more. And then as you acquire more properties in your portfolio, as long as they're all within a 3-year period, each time your interest rate and your monthly payment will decrease. In reference to cash needed at the closing table for a fix and flip, it depends on the loan terms, the purchase amount, and the total loan amount. The one example that I showed, it showed that they needed to have about $25,000 in a checking account. But you know what? I can do a live scenario here. Hold on one second. All right, I'm trying to figure out these screens. Can you see the screen here with me logging in?
Yes.
Okay. All right. So this is a calculator that we use. And I like it because it gives us real-time data and information. I can pull it within minutes. Let's see. So we're going to calculate a loan. Okay, Priscilla, give me a scenario. We're doing a fix and flip. Is that what you, okay, so a fix and flip property. So this is a short-term loan and this is a brand new purchase. And the property type, do you want to do a single family or 1 to 4 units? Or 2 to 4, I mean.
Let's say single family.
Okay. So a single family property. So you see it automatically populates at 12 months for the long term, but
Okay.
you can decide 9 months or 18 months.
Okay.
Also, let's just say you get to that 12 months and the rehab is still not done. You can request an extension. They usually do it in 2 to 3 month increments. So if you get to the long term and it's not completed, it's always good to submit that extension at least 30 days prior to it. Your long term expiring, because if not, the interest rate goes to like over 20%.
Okay. Oh,
Which you want to avoid at all costs. So 12 months. Now completed flip experience. You want to do 0 experience or how much you want
no,
to
zero
0?
experience.
Okay. All right. And then estimated credit score. Let's just do one at 700.
Mhm.
And then a zip code. You have a zip code you want to give me, or
Let's do 19701.
okay.
There.
What is the as-is value of the property
Um,
or the purchase price? You can give me the purchase price.
oh, 150.
150.
Mm-hmm.
And we'll say that the purchase price is the same as the as-is value for this.
Mm-hmm.
Your total rehab cost, how much will you have to put into the property?
100,000.
100. Okay. They added some extra fields here, so this has been updated. And then after you put $100,000 into this property that you purchased for $150,000, what will the ARV be?
Say 380.
380. Okay. All right. So in doing this, they do just ask the questions like, are you making any major property alterations? Is
No.
this going to be a tear down and a rebuild? You know, things of that nature. Usually the answer is no. And especially with no experience, you don't want to go in there trying to tear down things and altering a property too much. Okay, so now we're going to calculate the price. And then here is the terms here. So based on this loan, 150,000 as is value, 100,000 rehab, your proposed loan amount would be $225,000. They
Okay.
will give you an initial advance of 125,000. So that's 83% of your purchase price. Okay. So if your loan was 150,000, I'm sorry, your purchase price is $150,000. They only want you to bring in $25,000 of the purchase price, which you see over here, the down payment.
Okay.
This has an interest rate of 10.49%, but you can buy down this interest rate also to either pay more money at the table or less.
Okay.
So this one here has a 10.49%. So your total fees at closing for this property would be $33,270. However, the estimated liquidity requirements, this is the amount that the lender wants to see in your account. So you're not going to use this amount. They just want to see that you have that extra cushion to cover anything, that may happen unforeseen. And that's $55,071 that you have to show in an account.
Does that include the closing cost, or that's outside of the closing cost?
This is an estimate of the closing costs. So yes, it includes closing costs, but it's only an estimate.
Okay.
Okay. And
Okay.
that's closing costs, meaning on title. That's what you mean, right?
Yes.
Yes. Okay. Yep. It's only an estimate. But yes, they do try to include that in there. Okay. And then let's see. So from this here, I can download your term sheet. Can you see the price term sheet?
Yes.
Okay. Here is the term sheet here. It shows you what the monthly payment would be. Where is that? Okay. Your monthly interest only payment while you're doing the rehab for this property will be $1,092.71.
Okay.
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 Um, let me see. Okay, yep. So this is what I would email to you. I was seeing if it was anything else on here. Did I explain that to you? Okay, you understand that or?
Yes, I do. I understand.
Okay, all
Thank
right.
you.
Any questions from that?
So once you finish this, now we finish rehabbing the property. The
Mm-hmm,
value or the after repair value is 380. Then
mm-hmm.
you have to do an appraisal, right?
Yes.
Okay. And when you do the appraisal and let's say it's either above or below the 380, what
Mm-hmm.
happens during refinancing?
I'm sorry, what was the last part?
If let's say you do the appraisal and it's let's say 420,
Mm-hmm.
it's do you take that extra money out?
Yes, yep, if you want to, you can take up to 75% of that. So we can do that scenario actually. So let's see, the loan amount for this one would be $225,000. So now let's do the other scenario for a cash out refinance to see how much you would be able to pull out once you did the refi. So now we're going to change this from a short-term loan to a long-term. And this is now a cash out refinance, no longer a purchase, and it's still a single family. I'm going to leave the credit score the same, the zip code. However, the as is value, you said 420,000.
Yes.
Okay. Your estimated payoff is 225,000, but I like to do a little more just to cover other costs. So 235,000. And then prepayment penalty. Other than the state of Pennsylvania, you can decide what your prepayment penalty will be. If you purchase in the state of Pennsylvania, if the loan amount is less than $300,000, then there is no prepayment penalty. So you don't even have that option. So for this one, we usually do a 5-year drawdown, which means at year one, if you decide to sell the property, then you have to pay 5% prepayment penalty. At year two, it goes to 4%. Year three is 3%. 4 is 2%, and then year 5, you would do 1%. So if you decide to sell your property in those 5 years, then there's a prepayment penalty. Once you get to year 6, then there will be no prepayment penalty. Okay, so that's what the 5% is. And it usually defaults to that option unless the client wants something different. All right, so the completed rehab, so you put $100,000 into this property. This is where we estimate the insurance for a $420,000 property. I would do about $2,100, and then taxes could probably be around $1,900. It depends on where you live, though. So let's calculate that. Oh, the other thing is the rent. So rents, you want to be like around 0.08% of the total loan amount. So I'm gonna say, let's try $3,800 a month. And the reason why you want your rent to be at least 0.08% is because if the rent isn't high enough to cover the mortgage payment plus to have a little extra, it decreases the amount that you can pull out cash. So it'll take you down to 70 or 60% if your rent isn't enough. So you have to make sure that you estimate what the market rent is to make sure that it'll cover your mortgage plus other fees that you may incur with the property. All right, so this is the buy down table that I showed you earlier. With a as is value, a property appraised at $420,000, 75% of that you can cash out is $315,000. So $315,000 would be the new loan amount. If your previous loan that you're paying off was $225,000, then you would subtract the $325 from the $315,000, and that is the amount you could cash out on this property minus closing costs. So that comes to $90,000 minus closing costs, which I would estimate at about, well, actually, we don't have to estimate. We can see it right here. Hold on. So if you decided that you wanted as much cash as possible, you wanted to do 0 points at the closing table, you would get a 7.1% interest rate. Your monthly payments would be $2,450. And your total closing costs would be $11,220. So that $11,220 would come from that $90,000 that you would get. Does that make sense?
Yes, yes.
Mhm.
Very interesting. It makes sense.
Yes. And then let me just show you the difference. If you decided, okay, I want a lower interest rate, so a 6.1%, 6.16, and then monthly payments of $2,255, which is almost $200 less than at the higher interest rate. So if you decide to go with that option, just so you can see what the difference is, you would be paying $22,000 in closing costs. So you would subtract that from the $90,000. So this decision here is all based on what your goal is. Do you want the cash up front, or are you more concerned with long-term, a lower interest rate and a lower monthly payment? All right, so that's the cash out refinance example.
Wow. Lot of information. Thank you so much.
Yes, no problem.
Anybody have any more questions?
Yes, I have a question.
Okay.
Okay.
So, yeah, thank you for the presentation. My question has to do with the previous screen. where you guys were doing the calculation for the single family house in Delaware with all of that, you had put like there was in terms of the money to bring to closing, it was like $55,000 or something. No, no, it was the money that the bank would like to see in your account when
Yes,
it comes
this
to
here.
closing.
Yep.
So, so my question is, does that also is that like all the monies that you have, so to say, like your check-ins, like your retirement account, or it's just like a checking account we're talking about?
Nope, you can combine multiple accounts. So
Okay.
it does not all have to be in one account. You can have, I don't know, I don't think there's a limit. So you can have multiple account with different money in each account.
Okay. And then the second part is, does that mean it has to be money that you could pull out? So this is not like your kids, something you put for your kids and you'll put it on there because you don't have access to it. So it has to be money you could access to if you need to, I'm assuming.
So the only portion that you have to have access to is the lender and loan fees estimate here, which is the 33,000.
Okay.
So of everything that you send over, you need to have at least the $33,000. Keep in mind though, that does not include closing costs at the table. So I always like to add a little more cushion, when I giving a scenario or a term sheet to my client so that you make sure that you have a little more than what this number shows here.
Thank you so much. Very, very insightful. Very insightful. Thank you.
You're welcome, no problem.
Right. So with this, so multiple people can come together and apply for the loan, right? On one property.
You said multiple people, like partners that you can have on a loan, a property?
Yes.
Yes, yes, yes. What's your question about it?
Yeah, I'm saying that's possible. Like maybe 3 or 4 people coming
Oh,
together.
yes, yes, definitely. So, um, there's a couple different options with that. If you have multiple partners, then you as a team decide if everyone is going to guarantee the loan or if there's only one or two that's going to guarantee it, but the other ones are on there just as I guess I don't want to call it shareholders, but just having a ownership percentage, a percentage of ownership. So you can decide if everyone's going to be on the loan where they're guaranteeing the loan, we're looking at everyone's credit, or if they're just going to be on the operating agreement showing that they have percentage of ownership in this business and in the real estate.
Okay. Thank you.
Yes, no problem.
Any more questions? All right. So, I mean, this is a lot of information, and I hope we are taking notes and we are also um, thinking through how we can invest in real estate now that we understand how the different properties works. Ms. Priscilla showed us that a few weeks ago, and now Ms. Baker is showing us how to get a loan. So we have no excuse to not look into this option as a way of generating additional income. I mean, you can have your full-time job and do this on the side and still generate some extra income. Okay. So this is good. I have one question that I just need to ask you. How did you come up with your business name?
Um, Actually, so it started out with, let me see. I read a book a long time ago about guerrilla marketing. Have you heard of guerrilla marketing? Like, um, just I think it's like a marketing method. So I used that word gorilla and turned it into girl and then end up coming up with guerrilla consulting. But it started out as Guerrilla Properties. That's one of the entities we use for some of our real estate. So we have Guerrilla Properties and Guerrilla Consulting.
Ah, okay.
Yeah.
It's very unique.
Thank you.
I
Thank
find
you.
So this is it. I mean, personally, I'm gonna make an appointment and come see you. And I do have clients, or I do have viewers from pretty much all over the country. And I think one of the major question is, would you be able to help them or assist with their loan, even though they don't live in Delaware? And I know you said you service pretty much the whole 50 states. So if they need loan based on where they are located, I'm assuming they can still reach out to you.
They absolutely can. Yes, we have clients all over. So yes, not just local to Delaware or Pennsylvania. We have clients in multiple states across the country.
Can I
Okay.
ask a quick question?
Yes,
Thank you so much for arranging this, Dr. Eugenia and Miss Baker. Thank you so much. Very informative.
you're welcome.
My question is, if you have a business name, like the way you have Gorilla Properties,
Mhm.
but you're the individual that is applying for the loan, how does that work? Would that still be viable through your organization?
Yeah, so you said you have a primary business name, but then you have did you say a DBA?
Correct. So if you wanna, own a property, you wanna buy one of these properties,
Mhm.
but of course you're using the property is going to be under the business name, but you're the guarantor as the individual for the loan.
Yeah, so for the loans that we process, they're all in a business name in an LLC. So it can be for your primary business, or maybe you just came up with a LLC or a business name just for this property specifically.
Okay.
Yes, you can purchase the property in any LLC you want, but it cannot be in your primary name. That's a good question because I didn't mention that. So it has to be in the business name. And then we do have to show the business entity documents. So your EIN number, your incorporation that you filed with your state, and then your operating agreement. Those are the three documents that we need to show. In the beginning and for the first loan, there are a little more documents that are required, but that's just to get you started and in the system. And then, once you acquire your next properties, we don't need as much. But yes, we do require those entity documents in the beginning. Thank you for asking that question.
Thank you.
Hi, ladies. I'm Eunice, and this is a wonderful presentation and very informative. I have a question. So, if you want to, like the beginning, you said flip and fix about the loan, and maybe let's say you want to do it as a business, you want to partner with, a couple of people. Do you have to work under a broker, or you can be by yourself?
Under a broker for the loan itself?
Yes.
No. So there are companies where you can just go to directly to get the loan. But then there's also some lenders that work directly with brokers. So
Oh, okay.
you can do it individually yourself.
Oh, okay.
Okay, but so I would just recommend that when you look that up, just do research. Like when I first started, I would call as many people as I could. I didn't even have a property. I just made up a property scenario to see what rates and everything they offered to figure out which lender I wanted to start out with first. So yes, you just have to do that groundwork. You don't want to go with the first one that you call.
Right.
Yes, and then just make sure that there's no hidden fees and all of that. So once you call multiple companies, compare each of the term sheets and see what they offer, see who has those extra fees, and then which ones you wanna move forward with.
Right. All right. Thank you.
You're
I have
welcome.
a question. I
Mhm.
came in, unfortunately, at the tail end of it. Is this recorded?
Yes, it's
Okay.
being recorded and it's also on YouTube or on my website if you want to watch.
Okay. Thank you.
You're welcome. All right, Miss Baker, this is good information, and I know our time is up. Can you put your contact information up on the screen one more time, please?
Yes, I can. I'm sorry, I forgot my camera was off. Give me 1 second. All right, here it is. So it's www.girl, Girl, Rill, consulting.com.
Okay, and then you'll find your phone number, your email, all that on the
Yes,
website.
actually, I can give you phone number now. I'm sorry, I didn't put that on there. It's 302.
Give me 1 second, I can put it
Okay.
as well. 302
344
344
4970.
4970.
Yes.
All right, that's Miss Myeshia's Baker's number 302-344-4970. Make sure you reach out to her. And if you have more questions, if you are ready to find a property and start generating extra income, please go for it. I am making my appointment for Monday if she's available because I have more questions, but I know our time is up. We may need a second part of this, but I'm very grateful to have you with us today, and this information is priceless. And I
Thank
thank you so much for
No
what
problem. Thank you for the opportunity.
Thank you, Myeshia.
Thank you, Priscilla.
So if
Thank you.
you need to get
Thank you.
information about properties, Miss Priscilla Yeboah, she was with us a couple of weeks ago. She shared a lot of information with us. If you weren't here or you missed it, please go to my website, www.dreugeniacaternor.net, or you can catch us on YouTube and watch the whole episode. If you want to get information about the loan, please again reach out to Miss Myeshia Baker. All the information will also be on the website if you want to watch it again. And if you need to reach me, is 443 623 6080, or email me, Dr. Eugenia Caternor at gmail.com. Please try to follow us, subscribe to YouTube, Dr. Eugenia Caternor. Share the information, don't keep it to yourself. And also like us online on Facebook, on YouTube, on Instagram. Thank you all for joining, and we'll come back with more exciting information, exciting topics, and exciting discussions in the future. Okay. And if there's nothing more to be said, bye everyone, and we'll see you soon.
Thank you. God bless you.
Thank
Yep.
you.
Thank you. God bless. Good night.
Bye bye.
Thank you.
Good
Mhm.
night.
Thank you. Good night.